Sometimes it feels like the U.S. stock market is just all over the place. Daily news, these wild swings.
Uh-huh. It can definitely seem chaotic.
But underneath all that noise, there are these bigger long-term forces really shaping things.
Absolutely.
So today we want to cut through some of that confusion. We're doing a historical deep dive, looking at what's really driven the market over the long haul. Hopefully give you a clearer picture without drowning you in details.
That's the plan. Yeah, we're basically taking a journey, 70 years actually, from 1948 right up to 2018.
70 years. Wow.
Yeah, looking at these key periods, the whole economic backdrop for each one, and importantly, the policy decisions that kind of nudged things along.
And the goal is to pull out some core insights
Right.
about how the market really works over time.
Exactly. Find those patterns, the surprising facts maybe, that emerge when you look at the big picture.
Okay, so where do we start? Post-World War II.
Let's start right there, 1948 to 1968, often called the Golden Age for the U.S. economy.
Right, the Golden Age. Now, our sources don't give super detailed breakdowns of why it was golden for the market specifically, but the context is huge, isn't it? Post-war recovery.
It's massive. I mean, think about it. The U.S. was this dominant industrial power in a world basically rebuilding itself. The war itself had built up this incredible industrial capacity, spurred a lot of innovation.
Okay.
Then peacetime hits, and you redirect all that energy. You've got pent-up demand at home and, well, a global market opening up.
So a massive tailwind for the economy.
A huge tailwind. It wasn't just recovery, it was building something new.
Yeah.
And that naturally fueled the stock market. It provided this incredibly strong foundation.
Okay, but like you said, not always smooth sailing. Things changed.
They definitely did. The next stretch, 1969 to 1981, was, well, pretty rough.
Stagflation, right? That weird mix.
Yeah, stagflation, high inflation, but the economy's sluggish, not really growing. It's frustrating.
And the market reaction.
Well, our sources use the term "shrutja," basically, treading water, going nowhere.
Yeah. So why was it so stuck? What was going on?
It was a real puzzle for policymakers. The usual economic fixes didn't seem to work, or they'd fix one problem and make the other worse.
Like trying to fight inflation might slow the economy even more.
Exactly. Tighten money to curb inflation, and oops, you might push things towards recession. Unemployment goes up.
So uncertainty ruled.
Total uncertainty. Plus real economic pain for people and businesses. It just created this risk-off environment, The market just couldn't get traction.
But then things did turn around. The next period, 82 to 94.
Right, a rebound. The market starts climbing again, building momentum.
Our sources describe it as a U. So it shot up, then kind of paused to gather strength.
Yeah, that's a good way to put it. A period of growth, maybe followed by some consolidation, getting ready for the next leg up.
What drove that recovery? What changed?
I think a really big piece was monetary policy finally getting a grip on inflation. It took sustained effort, but bringing inflation down created a much more stable base.
Stability helps.
Absolutely. And alongside that, you had some productivity improvements, some structural reforms making the economy a bit more efficient.
So getting the fundamentals right.
Pretty much. It really shows how crucial those underlying economic conditions are for any kind of sustained market rally.
Okay, now we get to the really dynamic part. The late 90s, 1995 to 2000.
Ah, yes. The new economy.
The dot-com era. High growth, low inflation, this huge shift to tech.
And as the sources say, a bubble.
What was fueling that incredible surge, especially in tech?
Well, it was the internet, wasn't it? And all the tech around it. It felt genuinely transformative.
Like it was changing everything.
It really was. How businesses worked, how people connected. I mean, the innovation was happening so fast.
Which created massive excitement.
Huge excitement, huge investment, especially in those companies leading the charge. And, biotech had its moment then too, maybe a bit too much enthusiasm there as well, looking back.
The third biotech bubble, yeah.
The core idea was just unprecedented growth, endless profits from these new technologies.
But it wasn't lifting all boats, was it? The sources mention cyclical stocks didn't do great.
No, exactly. And even consumer stocks were just kind of average. All the focus, all the money was pouring into tech.
And we also had financial innovation, asset securitization starting to bubble up too.
Yeah, more complex financial products were being developed, trying to make markets more efficient, but maybe adding hidden risks too.
And Greenspan even warned about it, didn't he, in 96?
He did, the famous irrational exuberance line. A pretty clear signal that maybe, just maybe, prices were getting detached from reality.
Especially in tech.
Especially in tech, disconnected from the actual underlying fundamentals.
And the late 90s weren't happening in a vacuum either. There were global things going on.
Right, you had the Asian financial crisis in 97.
Yeah, that was serious.
Then long-term capital management nearly collapsed in 98, that hedge fund.
Oh yeah, I remember that. Required a big bailout.
It did. And then, to top it all off, you had the Y2K scare looming in 99.
God, Y2K. Feels like a lifetime ago. A weird mix of fear and greed, huh?
Definitely. These events were reminders, even with a booming U.S. economy, we're linked globally. Shocks elsewhere matter. LTCM showed how interconnected finance was.
And Y2K just added noise, uncertainty.
Yeah, a layer of anxiety, maybe some speculative bets too, heading into the millennium. Though, thankfully, it turned out okay.
Mostly okay, but then 2000 hit.
And the NASDAQ burst.
Flop.
A really sharp correction. A big reminder that even revolutionary tech isn't immune to speculation and, well, bubbles.
What was the big lesson there? Valuation matters.
Oh, absolutely. Valuation. So many of those companies had these sky-high prices with, frankly, no earnings, no clear path to profitability.
Just hype.
A lot of hype. It really hammered home the need to look at fundamentals, even when things seem exciting and new.
Which brings us, unfortunately, to the next phase, 2001 to 2008, described as a real struggle.
Yeah, a tough period, marked by some major shocks.
It started almost immediately, didn't it, 9/11 in 2001?
A massive shock to the system, huge uncertainty, direct economic impact.
And then the Enron scandal broke that same year.
Right. Which opened the floodgates, really. 2002 saw all this widespread accounting fraud come to light.
WorldCom, Tycho.
It shattered trust. Trust in corporate reporting, in governance, made investors incredibly wary.
So geopolitical shocks, corporate scandals, and then war.
The Iraq War, starting in 2003, more geopolitical instability, more risk, just dampening any market enthusiasm.
Amidst all this, what was the Fed doing? The sources mention interest rate moves.
Yeah, it's interesting. They did the first rate hike after the dot-com bust in 2004.
Okay.
Then they went on a tear in 2005, 8 hikes.
8 times in 1 year, wow.
Yeah, suggesting they were getting pretty worried about inflation, maybe linked to the housing boom that was building.
But then they cut rates in 2006.
They did,
Yep.
Which in hindsight might suggest they started seeing cracks, maybe worried about growth slowing down, perhaps in housing. It was a tricky balancing act.
And we know how that ended, 2007.
The subprime mortgage crisis hits. And it wasn't just a U.S. housing issue, it went global, fast.
A full-blown financial meltdown. Not just the downturn, but the system itself was at risk.
It really was. It exposed just how interconnected everything had become, how complex and maybe misunderstood some of those mortgage-backed securities were.
Capacity.
Yeah. And when housing prices turned, defaults cascaded, credit froze up.
Yeah.
It was severe. The risks spread like wildfire.
Okay, so after that firestorm, we get to the most recent period in this deep dive, 2009 to 2018.
The 10-year slow bull market.
Slow but steady coming out of that deep, deep recession.
Exactly. And the defining feature, policy-wise, was quantitative easing, right? QE.
Right. The Fed pumping liquidity into the system.
Unprecedented steps to prevent total collapse and try to get things moving again. But the recovery itself felt slow. Some called it long-term stagnation, even with the market going up.
But within that slow bull market, there were definite winners.
Oh, absolutely. See, sources talk about these, Tanya,
A profit-driven tech rally.
led by the tech giants, the FAANGs, basically.
Yeah, Apple, Amazon, Google. Their dominance really cemented in this period.
Huge profitability, strong business models, they just pulled away.
We also saw biotech continuing its run, right? The fourth wave.
Yep, continued innovation and investment there.
And consumer discretionary did well. Amazon, obviously, a huge part of that.
Definitely. Reflecting that shift to online changing consumer habits, Amazon was, well, Amazon.
It's interesting, though. It wasn't just tech and biotech.
No, you're right. The sources mention railroads, military stocks showing resilience, good old reliable industries.
And consumer staples.
Yeah.
Providing decent returns.
Yeah, steady absolute returns, maybe not beating the market overall, but holding their own, shows the value of diversification, different sectors playing roles.
And one other factor mentioned, Stock buybacks.
Ah, yes. A big feature of this bull market. Companies buying back their own shares.
Which can boost earnings per share, push up prices.
It can, though, the overall economic benefit is debated. But it certainly played a role in the market's performance during that decade.
And just as a reminder, even this long bull run wasn't perfectly smooth. There was an adjustment, a correction, in 2018.
Good point. Even the longest bull markets have pullbacks. It's normal, healthy even. A reminder that risk never disappears entirely.
Okay, so we've covered 70 years. Post-war boom, stagflation rebound, tech bubble and bust, the financial crisis struggle, and then the slow bull. Wow.
It's quite a ride when you lay it out like that.
What's the big takeaway for you looking back? I mean, one thing that jumps out at me is just how unpredictable it all seems in the short term. So many shocks.
That's absolutely true. The short term is incredibly noisy, volatile, influenced by everything from geopolitics to just sentiment.
Yeah.
But, and this is the crucial part, when you zoom out, look at that 70-year arc, a different picture emerges.
Which is?
A persistent underlying trend towards growth, towards prosperity, both in the U.S. economy and, as a result, the stock market.
So despite all the bumps, the bubbles, the crashes, the recessions, the long-term trajectory is up.
Generally, yes. The data strongly suggests that. Of course, past performance isn't guaranteeing future results, but the historical pattern is powerful.
What drives that long-term upward trend, do you think, even through all the chaos?
It's those fundamental strengths, I believe. Things like innovation, technology constantly advancing, gains in productivity over time.
A dynamic economy?
A dynamic, adaptable economy. Entrepreneurial spirit, a relatively stable legal and political system compared to many places, a large consumer base. These things create this powerful engine.
An engine for long-term growth that tends to overcome the short-term setbacks.
That seems to be the story that history tells us. We'll definitely have more volatility, more downturns, but those fundamental drivers tend to win out over decades.
This has been really helpful, actually. Putting the day-to-day market madness into that much bigger context, it makes things feel a bit less random.
Perspective is key, isn't it?
Definitely. So, okay, thinking about everything we've discussed, all these cycles, these shifts, it leaves me wondering, what current trends, maybe economic, maybe technological, should we be watching now? What might be signaling the next big market shift or the next long period of growth? Something for you, the listener, to think about.
That's the million-dollar question, isn't it? What's the next chapter in this ongoing story?